I want you to think about the biggest, most hyped stock you've ever seen go public. Maybe it was Uber or Airbnb or maybe even Rivian, which hit a $100 billion valuation before it had barely delivered any electronic trucks. Those were big deals, massive headlines, billions raised, and yet SpaceX is going to make them look like chump change. Elon Musk's rocket satellite and now AI company is targeting a June 12th listing on the Nasdaq under the symbol of SPCX. The reported valuation is going to be $1.75 trillion. To put that in perspective, that's bigger than Meta. It would make SpaceX on day one of the top 10 most valuable companies on the entire planet. And here's what the hype machine won't put on the headline. The company lost nearly $5 billion last year and $4.3 billion in a single quarter to start 2026. So how do you square a $1.75 trillion price tag with numbers like that? Well, today I'm going to look under the hood of this IPO. We'll review the real financials and risk and what Wall Street isn't telling you. I'll also give you an actionable take on how to play it, including stocks to follow right now that aren't just YOLO speculation. By the way, I'm Steve Reitmeister, and I've been investing for over 40 years. I was previously the editor-in-chief of Zacks.com for nearly 20 of those years, and now I'm a partner at WallStreetZen, where I help develop the Zen Ratings quant model and manage the Zen Investor stock picking newsletter. Over the decades, I've learned a lot about locating high-quality stocks, and I'm happy to share my insights with you today. So if you like breakdowns on timely market catalysts like this one, then please give this video a like. It helps me a lot. Much appreciated. All right, now for the reality check. The first thing you need to understand about this IPO is that SpaceX may not be the company you think it is. When you say SpaceX, people picture rockets, Falcon 9, Starship. That's the brand. That's the mythology. But the rocket business actually lost $657 million last year. And Starship, after 11 flight tests, has yet to successfully deliver a single commercial payload. By their own S1 disclosure, that first commercial payload is not expected into the second half of 2026 at the earliest. What actually makes SpaceX money is Starlink, their satellite internet division generating $11.4 billion in revenue last year, 61% of the entire company. Now, it earned $4.4 billion in operating income. Now, that's pretty impressive, but still far from explaining a nearly $2 trillion market cap to get the party started. This leads us to their February announcement where Musk merged his AI company xAI into SpaceX. This is after it already absorbed X, formerly known as Twitter. So when you buy SpaceX, you're not just buying rockets and satellites, you're buying X, and you're buying Grok, one of the most expensive AI buildouts in the world. Back to the reality check. xAI lost $6.4 billion in 2025, and then it lost another $2.5 billion in the first quarter of 2026 alone. And they disclosed plans to keep scaling aggressively, which no doubt brings more loss. Right now, Starlink and X are the only proven businesses. The rest of the $1.75 billion valuation is based on hope and hype. Now, let's talk about what this means for you as an investor. Here's yet another reality check. Whether you like it or not, you might be investing in SpaceX soon. When the stock lists, it will be added to the Nasdaq index, and no doubt it will be added to the S&P 500 in time, given its enormous size. So if you own any of these index funds, you will soon own SpaceX, whether you like it or not. Thus, it's worth taking the time to get familiar with the numbers. This is all directly from their S1 filing. Let's start with a review of revenue, which grew 33% last year. But that's actually slowing down from the past. Q1 2026 came in at 15% year over year. That deceleration is concerning when you're asking for that current sky-high valuation. Losses are moving in the wrong direction. Net loss was $528 million in Q1 of 2025. 1 year later was $4.3 billion in a single quarter, nearly tenfold worse. The total losses stacked up since day one now sits at $41.3 billion. And the cash on the balance sheet dropped from $24.75 billion at the end of the previous year to $15.85 billion by the end of March, meaning they are burning cash pretty darn fast. The primary reason is massive investments in AI, and who isn't doing that these days? SpaceX spent $7.72 billion on AI infrastructure in Q1 alone, more than its entire AI spending for all of 2024. Now, Starlink's economics are generally strong in isolation. The connectivity segment generated $2.1 billion in adjusted EBITDA in just one quarter. That is real profitable business. But here again, at nearly $2 trillion valuation, you're paying roughly 100 times trailing sales. To put that in perspective, the average S&P 500 company trades at around 3 times sales. So you are paying an enormous, and I mean enormous premium for a story that hasn't yet been fully earned. Okay, by the way, if you're liking this video so far and you would like to see my next one, then the best thing you can do right now is hit the subscribe and notification bell. It's the best way to ensure you see my future videos. All right. Now to address the sympathy rally. To be clear, you can't actually buy SpaceX till the IPO on June the 12th, but that isn't stopping investors and speculators. Enter the SpaceX sympathy play. Space stocks have been on an absolute tear since the SpaceX IPO news broke in late March. As of the week I'm recording, these stocks are up about 46% in the past couple months alone. Rocket Lab, Intuitive Machines, Firefly Aerospace, AST, Space Mobile, and Virgin Galactic, right? This isn't a slow grind higher. The market is front-running this IPO aggressively. But here's where I have to be straight with you. I ran all these major space stocks through the Zen Ratings quant model. In all, it analyzes stocks across 115 unique fundamental factors and then distills it into an easy-to-understand A-Def grade. Just like you remember from school, you want more A's and B's on your report card because D's and F's are going to get you punished. Across the board, these stocks are lacking according to the Zen Ratings model. The best of the pack is Virgin Galactic with a symbol of SPCE with a middle-of-the-road C rating. That is a hold at best. Intuitive Machines with a symbol LUNR lowers the bar to a D. That puts in the bottom 20% of all stocks. And then AST Space Mobile with a symbol of ASTS embarrasses itself with an F rating, putting in the bottom 5% of all stocks reviewed based upon its fundamental profile. The market has priced in the dream of what they could be. The model is telling you the fundamentals haven't arrived yet, and thus ownership is pure speculation. That said, there are 2 names that caught my eye as potential watch list picks. Before I get to them, I want to invite you to join me live this coming Monday at 7 p.m. Eastern Time. That's when I share my updated market outlook, plus my trading plan to beat the market, as well as the top 7 stocks for the week ahead. All this is more is part of our live training session this coming Monday at 7 p.m. Eastern. It's totally free. Just sign up at wallstreetzen.com/live. You'll also find a link in the description or scan the QR code. Look forward to seeing you there on Monday. All right, back to the 2 space stocks that I think are worthy of being put on your watch list now. First up, we have Rocket Lab with the symbol of RKLB. The company has the most credible story. Revenue was up 64% last quarter. It boasts a $2.2 billion backlog of business, and it was just selected for the Pentagon's Golden Dome missile defense program. SpaceX's own S-1 filing names them as a competitor. That's an involuntary endorsement. Rocket Lab has a C rating right now, which amounts to a whole recommendation. However, the Zen ratings are updated daily. A few key things could help the stock gain an upgrade in the system, making it worthy of purchase, right? For example, another quarter of 2 of that kind of revenue growth above 50%, or the backlog continuing to build, and or visibility towards serious profitability. But overall, the Zen Ratings needs to move to at least a B, which would put in the top 20% of all stocks. That would make the stock worthy of serious consideration for purchase, not just on the watch list as it is now. Now, let's think about the second stock to put on our watch list, in Planet Labs with a symbol of PL. This is a quieter name than Rocket Lab, but arguably the most interesting fundamental story. Last fiscal year, Planet delivered record revenue of $307 million, up 26% year over year. It also has a significant milestone, its first full year of adjusted EBITDA profitability and positive free cash flow. That's not a small thing for a company in this sector. On top of that, 98% of their annual contract value is recurring, meaning customers keep renewing year after year. That's the kind of sticky, predictable revenue base that holds up even when the broader sector gets volatile. Here again, we have a middle-of-the-pack Zen rating of C. The main limiter right now is its premium valuation. What would improve the investment picture is it becoming more profitable in the quarters ahead, that's improving the valuation picture. If that happens, it is likely the rating moves up to a B, then this would become a much more appealing investment. But once again, I got to be real with you. Perhaps instead of staring at the rocket on the launch pad, a better approach is looking at the company supplying the fuel. Earlier, I mentioned that SpaceX spent nearly $8 billion in AI infrastructure in a single quarter. That money has to go somewhere, right? And the companies sitting in the supply chain don't carry the valuation risk of the pure play space stocks. Instead, they have real earnings, real profit margins, and real Zen ratings to match. For example, one stock to watch right now is Dell with the symbol there. The stock has a B rating, which amounts to a buy recommendation. It's one of the strongest scores in the entire technology hardware sector, according to our model. Now, Dell supplies the servers and infrastructure that AI build-outs like xAI runs on. Every billion SpaceX spends scaling up Grok is a tailwind for a company like Dell. It's not a sexy story. It's not going to get its own Reddit thread, but it has the strong fundamentals to back up the current share price and likely more upside ahead. Another to keep an eye on is Western Digital with a symbol of WDC. Now, AI data centers need storage at a scale that is hard to state, and Western Digital is one of the primary suppliers. This stock has an overall B rating, which amounts again to a buy recommendation, and it gets super strong marks for growth and momentum. Again, not the sexy headline name, but when I'm looking at a sector like space stocks, where the headliners are mostly D and F rated, all the while, these picks and shovels plays like Western Digital, like Dell, are B-rated or better, then the investment choice becomes very easy. Listen, the space story is real, but the smarter money right now might be the companies quietly building the infrastructure that makes it all happen. So that's my take on the SpaceX IPO and the peer group. What do you have to say? Are you going to rush it and buy the IPO? And why do you think that the $1.75 trillion valuation is justified? Or are you sitting this one out, given concerns that it's mostly hype and hot air? Please share your thoughts in the comment section below for the benefits of our community. If you want to hear my take on another hot sector, then check out my video reviewing the quantum computing revolution and the potential stock winners there.